I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss today's policy announcement and our monetary policy report. Today, we raised our policy interest rate by 25 basis points to 5%. We are also continuing our policy of quantitative tightening. This decision reflects two broad considerations. First, monetary policy is working, but underlying inflationary pressures are proving more stubborn. We have made considerable progress in the fight against inflation. CPI inflation has fallen from a peak of 8.1% last summer to 3.4% in May. But even as headline inflation has come down largely as we forecast, underlying inflationary pressures are proving more persistent than we expected. Higher interest rates are needed to slow the growth of demand in the economy and relieve price pressures.
In response to concerns that the reduction in inflation could stall, the Bank of Canada increased its benchmark interest rate by an additional 25 basis points, reaching levels not seen since 2001. Some experts caution that the Bank of Canada runs the risk of sending the Canadian economy into a recession and displacing hundreds of thousands of workers and families unable to afford their mortgages. The Bank of Canada said on Wednesday morning that it is increasing its benchmark overnight interest rate by a quarter percentage point to 5%, citing an economy that was stronger than anticipated, a steady inflation rate more than expected, and a tight job market as reasons for the increase. The most recent action, according to economists, is a signal to Canadians not to anticipate rate reduction anytime soon and that further rate rises are not ruled out. A year ago in June, inflation reached a high of 8.1%, now, they believe it's 3.4%. All very speculative numbers. The Bank of Canada has also revised its 2025 2% inflation rate target, extending it by 6 months. Ontario Premier Doug Ford said, "I understand what they're doing, trying to knock down inflation, but what's the ramification of this? When these people have to renew their mortgages and they can't afford it, this isn't good for the country." British Columbia Premier David Eby called it devastating news for families. The idea is that by increasing the cost of borrowing money, people and companies would spend less, which will lower prices and slow the economy. The interest rate hike is now at its highest rate in 22 years. In the upcoming months/years, the pressure on middle-class mothers and fathers who work hard to support their families will continue to grow. The impact and implications of the continuous interest rate hikes have made it practically impossible to afford the necessities of life, such as food and a roof over your head. I see a multitude of individuals who will lose their homes as a result. Keeping your head high, having faith, working hard, staying healthy, saving money, and limiting non-essential expenditures are the greatest strategies for navigating this storm. You can't rely on the government, so you need to prepare for every outcome and take responsibility and make things happen.